I want to talk Apple, specifically the huge mountain of cash which they have, $261 billion. Come on in, our go-to guy on all things banking, Dick Beauvais. We brought you in, Dick, because any company with a mountain of cash, $261 billion strong, should surely qualify as a bank. Is Apple an undervalued bank?
Well, I wish I could tell you I know anything about Apple, but I don't. If the company has $261 billion in cash, what I would be asking is, what type of return are they getting on that cash? Because we've been doing a lot of studies lately of what banks are paying corporations for their money, and it looks like they're paying somewhere between 10 basis points and 45 basis points. When they take that money in from those corporations, they're turning around and lending it at 116 basis points, and that gap is phenomenal. So at some point, these corporations are going to say, hey, I'm not getting enough money from you from what I'm giving you, and therefore you better increase what you're paying me, and when that happens, it's going to hit bank earnings really hard.
Well, I mean, if and when Apple, for example, ever brings its money back to the United States, they'll only do that if there's a much lower tax rate on that mountain of cash. If there is a lower tax rate on that mountain of cash, do you think Apple would bring that money back?
Oh, yeah, I think they would. I think that it makes sense to bring it into the United States because I still believe this economy is the best in the world, and I still think it's one of the best places to invest, money when you have excess funds, as Apple does, and therefore I think it makes a great deal of sense for them to bring it back.
Okay, let's talk banks and financial companies. I own a limited number of shares of the of the ETF known as XLF. As you know, Dick, it's a basket of financial stocks.
Right.
I've made some money on it. Now, you know what's going on in the banking industry, in the banking world. Should I sell some of my XLF now, take the money off the table, and leave some in the market to play?
Yes. I think that we've gone through one of the most fascinating summers, if you will, in bank analysis that you can imagine. Essentially, in the beginning of the summer or in the spring, when we said to start backing away from these stocks, you had 5 bank conferences in which hundreds of banks said things are great. Then you had all these banks passing their stress tests. Then you had, this increase in their dividends, in their stock buybacks. Then you had the market going up, and then you had every pundit getting on TV indicating that they want to buy financial stocks, they want to buy banks. And guess what happens? The XLF today is selling a tiny hair below where it was selling on March 1st of this year when we talked about backing away from this industry. So you have to ask yourself, what's going on? Everything that could go positive for this industry has gone positive all through this summer from the standpoint of the pundits. Everybody thinks that these stocks should be bought. The market's going up, and the stocks are not going up. So you then have to get back to the basics. Why are they not attractive stocks? They're not attractive because they're not selling anything. In other words, they have to sell loans, and they have to sell loans at very high margins to show their earnings going up. They're not selling loans. They're not getting these high margins, and they're at huge risk because the average big bank in this country is paying 10 or 11 basis points, as I just mentioned, for money, and they're turning around and they're selling it at 116 basis points, and someone's going to wake up and say, hey, this is crazy. These banks are not paying us enough for the money that we're giving them.
All right.
So I'd say get away from the XLF.
Okay, I have been warned, and maybe I'll sell some of it today. We shall see. Dick Beauvais, everyone. Thanks very much, Dick. See you again soon. Thank you.